Mutual funds in Canada have some of the highest fees in the world. They are also extremely popular investments for Canadians with $1.66 trillion invested in mutual funds. I used to work at a mutual fund company in Canada, so I know all the hidden tricks and downsides of them. And in this video, I'll go over all the reasons why I think you should avoid buying mutual funds. Hey, what's going on? It's Chris here at Wealth Awesome. Let me explain why I think mutual funds in Canada are awful. I must confess first though, I used to be part of the problem. I used to work for a mutual fund company, one of the largest ones in Canada as a wholesaler, as well as a financial advisor at the largest bank in Canada. And in both of those roles, I sold mutual funds. In my brief time there, I didn't spend too much time there. I did see all the inner workings and realized it's kind of a shady industry. So now I know all the hidden tricks that these companies use to squeeze as much profit as possible from you, the consumer, and I'm gonna share them here today with you. Stick around until after the list is done and I'll go over some alternative options to mutual funds you can think of buying instead. So the first reason why mutual funds are awful is the insanely high fees of mutual funds in Canada. A recent report by Morningstar in 2017 shows Canadians have some of the highest priced mutual funds in the world. And we score below average when compared to 26 other countries. You can see in the scorecard here, we're below average. While that's been better than the past where we've consistently ranked at the very bottom of the barrel, it still means we are paying super high fees unnecessarily. The same report shows that the median expenses are 1.98% for equity funds per year. So that's almost 2% per year, which is extremely high. Given a $100,000 portfolio, this means you'll be paying $2,000 per year almost. Over 20 years, that's almost $40,000 in fees spent. The IFIC reported that over $1.66 trillion is invested in mutual funds by Canadians. That means tens of billions of dollars are being spent every year in fees by Canadians towards mutual funds. That's a huge amount of money, and not even close to half of the fund managers will be able to outperform the market. I truly believe mutual funds are an inferior product that has cost the average Canadian billions of dollars in high-priced fees. These fees have been used to line the pockets and fund the bonuses of mutual fund portfolio managers and their teams, and make already rich corporations even richer. In my opinion, there are many better options other than mutual funds out there. The second reason why mutual funds are terrible is that they're not expected to outperform. Okay, so now we've established that mutual funds in Canada are super expensive. And if you're paying a super high fee for something, you expect it to outperform the lower fee alternatives, right? Well, in the case of mutual funds, no, that's not the case at all. According to the latest 2020 mid-year S&P Indice versus Active or SPIVA scorecard, which compares the performance of active versus benchmark, 88% of Canadian equity funds underperformed their benchmarks over the past year, in line with the 90% that did so over the past decade. It gets even worse when you look at the Canadian funds that are invested in US equities, mutual funds. The US market is the most competitive one in the world, so it's even harder for active managers to beat the market there. And the 10-year performance of actively managed mutual funds underperformed the market by 95.24%. So 95% of active managers have not beat the market over the last 10 years for the US equity markets for mutual funds. So you're paying a super high fee for a product that underperforms the market. Sounds fair? Not really. The third reason why mutual funds are awful is that you're usually only offered mutual funds at a bank branch. Okay, so I went over how mutual funds are super expensive and they underperform the market by a huge margin after taking into account those fees. So why are so many Canadians invested in mutual funds then, over $1 trillion worth? Well, I have some personal experience with that. My experience might help to explain this. When I first graduated from university and landed a decent job, I finally had some money to start investing. Not knowing too much about personal finance and investing at the time, I just walked into my bank and bought a few different mutual funds. And that is probably what many Canadians still do. It's the path of least resistance and the easiest way to invest. It seems so harmless, but there could be some serious long-term problems with this. If you go to a bank branch to get financial advice for investing, they will almost certainly try to place you in a mutual fund that charges a high fee every year. There isn't usually an option for ETFs or to buy individual stocks. And because the big banks in Canada have such a huge looming presence on every single corner of Canada, this fact alone is what contributes to millions of Canadians defaulting to mutual fund purchases and not taking too close of a look at the fine print or caring about the fees too much. 2% might not sound like a lot, but when comparing it to the other options and over the long run, it really is. Financial advisors in these branches are not bad people, but the incentives of the advisors are not aligned well with customers' needs. It's heavily sales related with very aggressive sales targets. There's a great documentary series on Netflix called Dirty Money, which talks about the Wells Fargo scandal, about financial advisors under extreme pressure to hit their numbers and placing customers in investments that might not be well suited for them. This goes on in all banks, even in Canada. Maybe not to such an extreme extent, but it does still happen, and I've seen it happen. They're extremely good marketing. Mutual fund companies spend a lot of time creating marketable mutual fund names and millions of dollars on marketing. They also push ranking metrics like Morningstar's 5-star reports and also brag about their genius portfolio managers. This is all to try to give the illusion that they can outperform the market consistently, but in reality, that's not what really happens. So don't fall for it. All these fancy stars and names like aggressive high growth funds or the background of a genius Ivy League portfolio manager doesn't really mean anything when you look at the data. And it doesn't mean that it will outperform the market in the long run. And that is what the data shows. Ask any of the financial advisors you speak to that are trying to sell you a mutual fund if that certain fund will outperform the market in the long term. And they are required by law to say no, there is no guarantee that past performance is predictive of future performance. The fifth reason why mutual funds are awful is because of survivorship bias. So let me explain what survivorship bias is. Here's how a typical mutual fund company works. Say they release 10 different funds. So given the track record based off of the SPIVA scorecard, about 8 or 9 of them will likely underperform the market in the long run after taking into account fees. The mutual fund company will then promote the heck out of that one outperforming fund and kind of ignore the rest of the funds in the marketing material. The problem with this though is you have the majority of investors in these already underperforming funds, and you won't know till years later. Also, the really poor underperforming funds are discontinued and then rolled up into another fund. This creates a survivorship bias, which means that you only get to see the surviving mutual funds' performances, and it masks the poor performance of the discontinued ones quite well. And guess what happens to that one high-performing mutual fund? Investors will start to flock to that one fund because of the great marketing that they push towards it, only to have it revert back to the mean performance and maybe losing money in the long run, which data has also shown that tends to happen. So what are some mutual fund alternatives? The first one are exchange-traded funds, or ETFs. ETFs are the main alternative to mutual funds. It has a lot of similar characteristics to a mutual fund, but to me it has much more benefits. And in 2020, there has been an inflow of $41 billion into Canadian ETFs and have been an extremely popular investing choice for Canadians, even beating out mutual funds for the 3rd straight year in terms of market inflows. Our neighbors down south are even more ETF crazed. In 2020, over $507 billion flowed into US listed ETFs, setting a new record. So why are they so popular? Some reasons to invest in ETFs over mutual funds are mainly, number one, they have way lower fees than mutual funds. You could get some of them at 0.05%. There's more trading flexibility, so you could buy and sell on exchange intraday. And tax savings as well. There's less capital gains because there's less trading going on, and you could defer the capital gains as well. The second popular alternative is investing in stocks. Stocks are a great way to get direct access to the investments that you choose, and they're very easy to customize it. There's also no management fees since you're the one managing the investments, so the cost to invest will be much lower. And it'll be even lower than ETFs if you do it right. Buying individual stocks though usually does involve higher risk than buying funds because your money is less diversified, so it tends to be a little more volatile depending on what you invest in. So be prepared for that if you decide to go with pure stocks. You'll generally spend more time also analyzing and researching stocks as compared to an ETF or mutual fund. And as a Canadian, I do recommend investing outside of Canada, not just Canadian stocks, due to what's called a home bias. Canadians do tend to love investing in a lot of Canadian stocks, but the US market is extremely strong, for example, and I like to hold some stocks in the US market. But beware though, you will usually be charged a foreign exchange fee. And going back to mutual funds, so if you've watched this video and you still want to invest a little bit in mutual funds or believe in the active manager story, then I would recommend going with the Vanguard Mutual Fund series. It's a reputable company and their fees are much lower than your average mutual fund provider. But there's only 3 funds available, so check it out. It might be right for you. Okay, so how to buy ETFs and stocks in Canada? Well, with both Questrade and with Wealthsimple Trade, you can buy ETFs for free with no trading commissions on their platform, which is amazing. I've included a link in the description. With Questrade, it comes with a $50 stock bonus, and with Wealthsimple Trade, there's a $10 sign up bonus if you decide to sign up. Check it out in the description below. So my thoughts on ETFs versus mutual funds. I'm extremely favorable to ETFs over mutual funds. And I almost view ETFs as like a Robin Hood type of product. We, the consumers, are taking the power and the money and the fees back from the rich and using it to better our lives and families in the long term. Instead of some portfolio manager making a huge paycheck, that money has now been drastically reduced and redistributed back to the people. To me, it's almost poetic justice in many ways. My overall feelings is mutual funds are like the older, outdated operating system that's been updated by the newer and better featured ETFs. Alright, so make sure you like and subscribe to the channel if you liked the video so you don't miss out on any future videos I'll be putting out every single week. Also, be sure to check out the blog wealthawesome.com. I talk a lot more about ETFs, mutual funds, and other investing tips, and it's one of the leading personal finance blogs in Canada today. And as always, thanks for listening.